They put a sock puppet on TV and convinced the world to buy it. Then they burned through hundreds of millions of dollars in less than a year. That puppet's name was the mascot for Pets.com, and the story that killed it is the story of how an entire market forgot to do simple math. This matters today because the same kind of fever, growth worship, marketing is proof, and ugly unit economics hidden behind headlines is back. Only now the shiny label is AI. Let's rewind to the late 1990s. The internet was new. It felt like magic. If you added .com to your name, investors smiled and prices spiked. IPOs were parties. Valuations were promises whispered in champagne glasses. Enter Pets.com. Founded in 1998, they sold pet supplies. Simple, boring, perfect. Except their plan was not to make a steady retail business. Their plan was to grow, fast, loud, and everywhere. They raised money, they hired celebrities, they bought an enormous, unforgettable sock puppet and filmed it as if it were A-list material. They went public, the ticker popped. The marketing turned into a slogan, growth solves everything. But there was a private truth behind the glitz. There are two words investors loved and two words they ignored. The loved, growth and scale. They ignored unit economics. Unit economics is boring sounding, but it is brutal. It's the math per customer. How much you spend to get one paying customer. How much margin you make from their purchases over time. If your customers cost more to acquire than they ever pay you back, no amount of marketing will save you. And Pets.com made that mistake en masse. Their average order included heavy, low-margin items, bags of dog food, litter, clunky supplies. Those things are expensive to ship. Shipping costs ate the margins. They spent aggressively to buy customers who ordered once and never again. They lost money on nearly every transaction. Do the uncomfortable math with me for a second. Imagine an average order of $30. Let's say gross margin on those goods is 20%. That's $6. Shipping eats $10. Customer acquisition? If you're buying clicks, buying ads, buying TV spots, that might be another $20 for that first customer. You do the math, $6 minus $10 minus $20 equals a $24 loss per order. Multiply that by millions of orders and you stop calling it losses. You call it a strategy collapse. The market didn't care at first because the narrative sounded better. Market share first, profits later. Growth as gospel. Investors poured money into any brand that could show increasing site visits, glowing press, and celebrity socks. And this is where the .com story flips into tragedy. It's one thing to spend to acquire customers if they come back. It's another to spend and watch them drip away. Retention was low. Repeat purchases were rare. Logistics costs stayed high. The burn rate was astronomical. By March 2000, the peak of the .com mania, the Nasdaq was irrationally inflated. Then reality crept in. The numbers couldn't be bent forever. Between 2000 and 2002, the tech-heavy Nasdaq lost nearly 78% of its value. 90% of the .com companies went to zero or stopped trading. Pets.com filed for bankruptcy in November 2000. That sock puppet sold at auction. The company's last move? Liquidation. So how did we get to a point where a company that fundamentally lost money per sale could raise dozens of millions and go public? 3 features of the system made it possible. 1, the attention economy. Media and PR fed the frenzy. A viral mascot and a Super Bowl ad became proof that a company had sticky demand. Fancy logos replaced balance sheets. Storytelling became a substitute for solvency. 2, venture capital incentives. VCs were chasing exits. They wanted winners whose valuations would explode. That pressure pushed founders to prioritize scale and headline metrics, users, page views, downloads, over profitability. And 3, market structure favored speculation. IPO markets were hot. Retail investors bought story and hope more than cash flows. The result was a feedback loop where attention created valuation and valuation justified more attention. Now the uncomfortable twist. The same forces are in play today, only the product is different. Replace .com with AI, and the headlines read like déjà vu. Startups swear they have a model that will change everything. Investors pour cash. AI mascots and logos replace sock puppets. Everything is framed as growth and adoption. But the core warnings are the same. Compute costs are not negligible. Training and inference cost serious money. If your business model depends on serving huge models per user and the price you can charge is low, you're back to the same unit economics problem. Shipping free features that cost a fortune to run is a slow cash hemorrhage. And there's another parallel. Hype-driven valuations create a new form of sunk cost thinking. Companies double down. They burn more cash to keep growth metrics flattering. Investors chase the illusion, hoping the story will turn real before the cash runs out. Sometimes it does. Often it doesn't. Let's dig deeper into the numbers that no one wants on the headline slide. Imagine an AI app. You say it costs $0.02 of compute per user per request. The company gives 3 free requests to every new user. That's $0.06 of cost before you earn anything. If it costs $10 to acquire that user through ads, and the average revenue per user over their lifetime is $2, you earn negative $8 per user. The math is the math. Marketing and PR cannot change it. During the dot-com era, the market let companies live with negative unit economics because future scale was the promise. The idea, reach critical mass, then monetize. For some, it worked. For most, it collapsed. Pets.com is the perfect microcosm. A cute mascot, a mass-market addressable audience, high hopes, bad margins, a PR machine, and a ticking cash clock. There's an irony here. The businesses that seemed the most modern were often the least modern in practice. They ignored proven retail wisdom, inventory management, supplier margins, shipping costs, and replaced it with buzzwords. The result was expensive, inefficient commerce wrapped in a cute costume. So why does this keep happening? Why do intelligent people repeat the same mistakes? Because of psychology. Humans are wired to chase patterns and narratives. We prefer a good story to a boring spreadsheet. The more people believe a story, the more momentum it gains, and the harder it is for rational doubts to break in. Herd psychology turns optimism into policy. Confirmation bias selects stories that fit the mood. Loss aversion keeps money flowing into the leader because no one wants to be the one who missed out. And incentives matter. When compensation, reputations, and fund returns are tied to grand exits, the squeaky wheel gets grease. Risk gets socialized. The upside is privatized to founders and early investors. The downside often lands on later shareholders and employees. Here's the scary part. The technology changes. The psychology doesn't. The metrics change names. Monthly active users becomes tokens consumed. Page views becomes API calls. The math at the bottom can look eerily similar. This is not a call to kill innovation. It's a call to remember the basics. Growth is not a substitute for profit. Hype does not equal moat. Public markets eventually ask for cash flows, not just clicks. So what should a sensible investor, founder, or curious watcher look for now? Look at unit economics first. Can the company make money on a single user without future monetization tricks? Look at retention. Are users coming back or disappearing after a novelty effect? Look at marginal cost. If every additional user makes you lose money, the only path to survival is price increases or subsidized lifetime value, both risky bets. And finally, watch the cash runway. Great stories don't pay salaries. There's an important social angle too. The dot-com crash wiped out more than shareholder wealth. It destroyed jobs, careers, and trust. It cooled funding for a decade. The citizens of that bubble paid a real price for a fiction. If history rhymes, then ignoring the rhyme risks repeating that social cost. But there's one more layer, one that turns this from history lesson into a live moral test. In a world with powerful AI, centralization matters. A few big players control compute, chips, and data. If the market keeps rewarding scale at all costs and punishes careful economics, we might see monopolistic consolidation that stifles innovation and concentrates power. Or we might see a healthier cycle. Maybe founders and investors learn. Maybe the next wave builds businesses that are profitable, sustainable, and genuinely useful. Maybe the sock puppet becomes a cautionary tale in a business school, not a plemtate. So which brings us to the question that should keep you up at night. When you read the next shiny headline about an AI that can do X, ask yourself, underneath the demo, where's the money? Who pays? How much? And what happens if the cost per interaction is higher than the revenue per interaction? History doesn't repeat, it rhymes. .com is not just a 1999 relic, it's a mirror. It reflects what happens when charm outruns math and narrative outruns numbers.
So here's the uncomfortable truth to sleep on. The future will be built by people who pay attention to the small things, the math per user, the real costs, the retention curves, while everyone else claps at the mascot. If you're investing, ask the hard questions. If you're building, sweat the unit economics. If you're watching, don't confuse noise with signal. And one final thought. Markets forget faster than memory. We love novelty. We need to balance that hunger with a scale of skepticism, because the next sock puppet might be more convincing, but the ledger will still be unforgiving. If you liked this kind of deep, slightly skeptical look at the money stories behind the headlines, hit subscribe. We'll keep pulling these threads apart. .com ghosts, AI promises, and the little math that decides our big futures. What do you think? Are we in a new bubble or a new era? The answer will depend less on the press releases and more on whether the numbers add up.